the NASDAQ is down about 22% over the past year. And so NASDAQ represents tech companies and all the risk assets. But on the other hand, if you were to go and look at like the bond market and the bond portfolios, bonds are down, like the BOND index, the long bond index, it's down almost 17% in the year. So for 30 or 40 years, you had this 60-40 bond portfolio, and then bonds will be a low return and stocks will be a high return. But if stocks trade down, people will shift their money to bonds, and the interest rates will go down, the bonds prices will go up, and you'll actually get a yield on your bond portfolio. And the reason it broke in March of 2020 is because interest rates got pegged to zero. So after we had lowered interest rates from 5%, 5.5% to 5% to 4.5% to 4% to 3.5% to 3% to 2.5% to 2% to 0, and left it at zero, then the debate was, can they take interest rates negative? If you can't take interest rates negative, then bonds don't act as a hedge to stocks anymore. I mean, you're at the end of the road for bonds. And what we saw with stocks is the Federal Reserve printed a bunch of money, pegged interest rates at zero, and then you saw all these risk assets explode. You saw the NASDAQ explode up and the S&P explode up. You had a K-shaped recovery. And in the K-shaped recovery, it's almost like the entire economy was in a train wreck or in a car wreck. I think what happened here is the Fed just pumped tons and tons of liquidity, and we stayed high for about a year and a half. And I remember when Jerome Powell said, "I'm not even thinking about raising interest rates," and said strongly that it'll be till 2024 before interest rates start coming up again. But here we are in 2022. And now instead of raising them a quarter point, each time, now they're raising them 75 basis points. So they're taking 3 steps at a time, multiple times. So we took the cost of money down faster than any time in history, and now we're jacking up the cost of money faster than any time in history. And the result is that all the traditional models are broken since we started dealing with this issue. MicroStrategy we had $500 million of cash, and we saw interest rates at zero, and we saw the stock market inflated in the summer of 2020, and we said, well, what are we going to invest in? And we looked around at everything. Should I buy gold? Should I buy land? Should I buy art? Should I buy some crypto asset? And what's going to happen next? So what we did is we decided to buy Bitcoin, and we bought $250 million of Bitcoin August 10th, 2020. And then around September 10th or so of 2020, we bought another $175 million of Bitcoin or something like that. And then we started buying Bitcoin more in December, and we kept buying Bitcoin. We ended up buying nearly $4 billion, $3.97 billion of Bitcoin over that time period. So in terms of like our strategy, MicroStrategy has just bought as much Bitcoin as we get our hands on since August 10th of 2020. And in that time period, stocks gyrated north, they gyrated south, currencies have changed. So let me tell you what's happened. MicroStrategy stock, our stock is up 94% since that day.
Well,
Bitcoin is up 77% since that day. The S&P index is up about 18%. The NASDAQ index is up 7.5%. Gold is down 16%. The bond market, if you just bought bonds, they're down 18%. Bonds are down 18%. And silver, if you think silver was better than gold, it's down 32%. Jeez. Now, if you go on and say, okay, well, fine, let's just buy big The greatest of the big tech companies is Google. Google is up 41%. Apple is up 39%. Microsoft's up 22%. You might have won. Those were all better investments in the S&P.